Good afternoon. This is Todd Colvin coming to you from the floor of the CME Group. We are talking equities, and those equities, while we've stumbled a bit, have recovered a bit. We did see a modest down trade, a mere 2%, that has since reversed. So the selling that we saw earlier in the week, ahead of month end, ahead of the Fed statement, possibly ahead of employment later this week, it seems to have waned a bit. And the buyers, while they haven't come in with both hands, have certainly lifted the market back to back towards the trend levels it was on before. So I think right now, this selling sort of panic, I don't want to even call it a panic, but the selling that we saw is certainly gone by the wayside. Buyers are back in, and again, only getting a 2% correction. So if you were looking to buy it on sale for 5%, you missed a boat. At least you did today. Market volatility saw a spike in the VIX index up to as high as, I think, 15.5, the highest it's been since August, but really not out of the range of, oh my gosh, this thing could fall apart, and reflected in the fact that equity indices did bounce back higher today and yesterday. I think that right now, the VIX index is again a target for sellers, and we've seen that time and time again, and eventually that will burn those sellers, but it hasn't really, going back over several years, had an adverse effect. So selling in the VIX, selling of volatility in the stock market continues as we return back to that old trend. And what happened with the Fed today? Well, the Fed put out a statement after the January FOMC, no rate hike expected. They got none. And if you look at what they're proposing down the road, yeah, we're going to see moderate rate hikes, I think, in 2018 as well as 2019. The market and the Fed expectations are starting to converge, something we haven't seen in a long time. And not even that took stocks lower. If you look over in treasuries, yields got as high as 275 in the 10-year. That wasn't enough to deter stock buyers. So I think right now we need to see some bigger moves, whether it become more aggressive Fed or it becomes from higher treasury yields, in order to get those stock buyers out. Remember, stocks are up 7+% year to date, so it's still the place to be despite the risks that it carries because they've gone straight up. Really, going back to November of 2016, it's been a straight shoot higher, so the risks are sometimes not seen as clearly when the returns are so high. So right now, I think equities resume that trend, maybe not at the pace we saw prior, but with employment coming out this week, and next month, we have a new Fed chair. Next month, we have his first testimony to Congress via the old Humphrey Hawkins testimony, probably in the third week of February. Those will be things we start to look at. Those will be things the stock market starts to eye. I think right now, though, that equities will continue to climb based on the tax cuts and based on what the president said at his State of the Union last night and the economic growth that's coming. There's still a lot of positives out there, and the equity markets are still going to reflect that. There is still a tremendous amount of demand to buy stocks. That has not gone away. This is Todd Colvin coming to you from the floor of the CME Group.